What is up, traders? Video 3 of the futures course here on YouTube right now, and we're going to be breaking down auction market theory, how to understand direction, and get key levels to trade from using the volume profile. So we're going to tie in everything that we learned from last time, and we're going to go into auction market theory, a deep dive, and really understand the philosophy that moves markets based on the number one moving principle, volume. So let's dive right into it. Now here on the screens we've got the volume profile for the NASDAQ. We'll be taking a look at the S&P as well, but understanding true market movement and structure is understanding how volume and true heavy-handed market participants actually create movement. That's the principle that we left off with in the last video. So we talked about market structure and movement in the last video, as well as an introduction to auction market theory, but today let's dive into it fully. Before we do that, we need to review it a little. Now, when we looked at the markets last time, we looked at auction market theory, we looked at it from a very basic and general understanding and concept. The idea of balance and imbalance, the idea of fair value and unfair value. We deem that generally a balanced area is going to be deemed as fair value in the markets. And strong-handed traders and market participants, they're positioned at the extremes of this balance or this fair value. So they dictate movement a lot easier from this understanding. They come together to create fair value and keep markets in balanced places by keeping supply and demand relatively equal for the majority of the market movement. Now, when we look at that, we have things like unfair value that leave these balances and distributions, and that's if strong-handed market participants decide that trending movements make sense at that point. So that's when supply or demand is generally greater than the other. So the whole point of auction market theory right now is trying to understand and being focused on where we can find balances in the market and where those extremes of balances are. So hint, hint, the extremes of balances are going to be areas that we're going to be looking to trade from, because that's where the strong-handed market participants are going to get active. So if we deem an area like this a balance, right, we have the volume profile that surrounds it that looks like a belly. The extremes of that area, right, the drop-offs in volume, those are going to be where the strong-handed market participants are. So that's something that we want to get used to identifying and understanding. Markets generally want to stay inside of balance, right? This happens the majority of the time because it's deemed fair value. This is where supply and demand come together and they're generally equal. So they search balance. When we're outside of these balance areas, markets search balance. If we're near all-time highs, we have what is a developing balance. If we leave a balance to the downside, what we look for is another prior balance to move towards, to move into. These large areas of volume are attractants for markets. So directional strength is dictated by moves within and outside of balance. What that means is if we have two balance areas, right, let's just move this along and look at a general example. If we have two balanced areas, depending on where price is in relation to both these balanced areas, that's where price wants to go, and that's the directional strength. What I mean is, if we move outside of this lower band balance, right, based on auction market theory, we're escaping an area that has heavy volume, and to do so, we have a move that goes through low volume realistically. So when we leave this heavier balance, the thought process is, let's see if we can continue the move to the upside swing, right? So what we're looking at in this instance is the continuation of the expansion outside of this balance. And if there's another balance above it, right, the target and the search is for that new balance. Now, directional moves, right, there's structure changes not only when we leave a balanced area, right? The structural change generally happens when we enter new balance areas to the upside or the downside, right? So last time we talked about trend direction, so let's take a look at how that plays out based on these balances. Now ranges, right, if we look at range trades, which is pretty much the majority of the movement where markets stay inside of balance, they're broken by the expansion outside of that balance to the upside or the downside. Now, one of the caveats that we talked about when we look at the NASDAQ or the S&P 500 is that the best way to see this kind of expansion, this trend move outside of a range or a balance, is to get a significant close outside of it, right? Or to get a significant move outside of it. On NASDAQ, I look at generally 50-point moves. On the S&P, I look at generally 10-point moves to expand out of these areas to start moving into the direction of the expansion outside of that balance. So strong-ended market participants, they're active at the extremes of these balances. They want to keep prices within, but when new information comes out, some kind of news maybe, or maybe we've tested the area just way too many times, what we're seeing in this instance is an expansion and we see a trending move. So that looks for the next area of balance. If there's no area of balance to the upside, markets want to create an area of balance. Now, trending moves, right, when we look at these same principles, realistically, again, with the example of two general balances. Now, if we take a look at a bullish trend, right, a bullish trend will hold as long as we continuously accept balances to the upside swing. So what that means is we're looking for movement naturally to leave balances outside to the upside, right? But we're also looking for movement to accept into balances higher, right? Or if we're at all-time highs, create their own balances. The more we can accept into areas of heavy volume, which are these balances, the more strength we have on the bullish momentum, because it takes a lot of buy side to enter an area that has such thick and heavy volume. Now, these bullish trend moves, right, they're not necessarily broken if we fail and leave a balance that we've explored to the upside. So for instance, we move into this higher band area. And if we leave this area, right, we leave into an area of low volume. Generally speaking, it is a starting point of a turning point, but still the top of the prior balance has the expectancy to try to push prices back into the heavier volume area, because this low volume area is seen as a very easy path to move through. So realistically, when we move into a low volume area, the balance that we've escaped has a pretty good chance of getting retested. A directional change in a bullish trend happens when we actually accept into a lower band balance rather than just leaving one. So if we have a move like this and we move into a new balance to the upside, realistically, it's not really a bearish flip until we actually accept into a balance area lower, telling us, okay, that's going to be the downside momentum move. If we look at a bearish move, right, it's the same principle realistically. Nothing really changes except for the direction. So this is how we can really cement directionality in the markets. If we look at a bearish move based on auction market theory, realistically, it starts by leaving a balance area, but it really opens up when we actually accept into a balance lower, right? So if we can flip back into a higher band balance, that tells us that the bearish trend is disrupted. Another factor, the concept of low volume areas between balances, right? Generally, in a perfect world, when we have a distribution, when we have a fair value area, when we have a balance of belly, they're all synonymous terms. When we have this kind of situation, in a perfect world, there's some kind of low volume area between the balances. That's not always the case, but assuming that there is a low volume area around these guys. Now, these low volume areas, whether to the upside or downside, they're generally seen as failed moves of expansion, right? The real expansion happens when you actually start moving into balance areas up or down. So if we take a look at this and we're trying to think of the concept of, okay, well, strong-ended market participants, they are active into the extremes. An area of very heavy volume, which is called fair value or balance, is an area that wants to keep price within. If prices are attracted to heavy volume, the expansion outside of this heavy volume, right, doesn't necessarily confirm a trend unless you start moving within a next balance. So oftentimes there are peaks and head fakes that happen outside of these distributions where you grab some stops, right? You get a little stop hunt, you get a little stop run, and then prices revert back inside this balance. This is one of those key factors to consider and remember when we start looking at the setups that we're going to be breaking down. So unless we get a move inside of a heavy balance to the upside or downside, there is a good chance that when we move into an area of low volume, if it's like a smaller move on S&P and NASDAQ, there's a very good chance that this is going to be a head fake and prices would mean revert back into that balance. So all this jibber jabber and breakdown of how this looks from a theoretical perspective. But how does the volume profile come into this? First, we have to understand what the volume profile is and what it represents on a very general and basic idea. The idea comes from the normal distribution, right? So if we look at a normal distribution based on statistics, we have this kind of bell curve, right? In the middle, we have the mean, and then we have the first standard deviation, and then second standard deviation, right? So on and so forth. So the first standard deviation is seen as well, it's not 70%, it's usually used as 67, but the majority of the volume is within that first standard deviation. So this is where the volume profile starts to come to light, right? This is where we use the value area, the 70%, and the value area high and low are represented by the barriers that keep that 70% together. So this is fair value, right? The further you extend into the tails of the expansion outside, you go -2 sigma, -3, 4 sigma, +1, 2, 3, 4, 5, 6 sigma. You increasingly become unfair in terms of value, which gives the markets two general options: to either get into a balance below, right, or snap back into the mean. Well, okay, not only get into a balance below, you can get into a balance above or create a balance above or snap back to the mean. Those are the two general understandings of the concept of the volume profile, right? So if we take all the information that we talked about so far, we can look at the basics of the volume profile, and then we'll take a look at how we use them based on all this auction market theory that we've been breaking down. So we can take a look at what's going on here with this volume profile. Now, the very simple way to look at this is that this over here with the lighter blue background is the extended trading hours session. This is the RTH, the regular trading hours session, right? So each one of these individual volume profiles represent a session. These volume profiles are attached to a market profile, but we're going to focus on this nice little rainbow colored profile here. Over here you have the last 5 days of trading. This right here is a 100-day composite profile. We'll get into this in a bit, but just to understand what it is that we're looking at. Why it's colored differently, right, to get that out of the way. The different colors are a representation of a percentage of the point of control. So assuming that the point of control is going to be 100% of the max volume, meaning that it is the heaviest point of volume on the volume profile, which it always is, it's in blue. Blue is going to be the heaviest amount of volume, then green, then we get into orange, I believe, and then yellow, and then red. Or it might be yellow and then orange and then red. So red is the lowest, blue is the highest, green is up there. So they're all representations of a heat map based on the point of control. So this is where thin volume is red, right? Heavy volume is blue and green, just to get that out of the way. Now, what is the volume profile, right? It's a charting tool that plots volume at each price level. Not just over time, but just based on the areas. Instead of how long did price stay there, like the market profile over here, we look at it and say how much volume actually occurred here. So it creates a distribution curve, right? Like a histogram along the y-axis of your chart. A distribution curve, like we talked about, comes from the normal distribution. So this volume profile, the sessions and the general shape of it is not going to be as picture perfect as that normal distribution that we drew. That's why there are a lot of different factors that come into this. So if we take a look at each part step by step, the point of control, which is the POC, this is the price with the highest traded volume in that session or the profile. Typically, it's denoted by an extended line, right? Right here on this profile, it's a white line. It's the area that has the blue volume, realistically. That doesn't mean you can't have blue volume elsewhere in the chart, but it's the bluest of blue with the white line on each individual chart that we have here. That's the point of control. It generally acts as a magnet. Markets often revisit it. There is a strong pull towards it, meaning that I don't want to initiate trades at the point of control because volume tends to hold prices there and they tend to rotate and just create chop around the point of control. Next off, we have the value area, right? The value area, like I said, is 70% of the volume traded, which is one standard deviation of activity. Here on this chart, you can see it's denoted by these two purple-blue lines, right? These two purple blue lines are the value area highs and lows, which sandwich the value area. If you look at the market profile, it's a little easier to see. It's just the white letters. That's what creates the value area on each individual chart itself. So we then have high volume nodes, right? High volume nodes are price levels with large expanded bulges. So if we take a look at these individual profiles, right, a lot of these group together. Generally, a grouping of high volume nodes together is what we call a balance, a distribution. So the high volume nodes are going to be the ones that expand the most. They represent general acceptance. Price spends a decent amount of time here. Business was done. A lot of contracts have been traded there. And then we have the low volume nodes. The low volume nodes are the red areas, right? Generally speaking, they're areas of huge drop-offs in volume that we see in multiple different profiles. They represent areas of rejection, right? Price moves through them very quickly, so away from them very quickly as well. But a lot of people, they get this notion a little mixed up, and they look at the whole block of the low volume node as a point of interest. So a pivotal zone in the markets is going to be the creation of the ledge or the extreme, which is the low volume node that drops off into a high volume node. So where these meet, these create the extremes and the ledges of the balance, which is where the strong-handed market participants want to get active. In these individual sessions, it's very cleanly seen where these distributions drop off and you have low volume that kind of encloses that balance drop off. So these can be important areas to trade from on an individual basis to basis, but once we start looking at the composite profiles and tying all these pieces together, we're going to get a much better understanding of how to use these volume profiles more effectively. So generally, the use of the volume profile, like I've said, we're looking at balance versus imbalance areas. Balance areas are areas where auction is in agreement, where there's consolidation, where we have this thick block of volume. And those are going to be areas where prices spend the majority of their time throughout the individual session and so on. So the imbalanced area is going to be the area of low volume where we've spent a very little short amount of time. We've gotten a quick burst of energy that created this low volume, and those are generally very easy areas to pass through. Meaning with this low volume over here, it could be very easy for price to come back down towards this balance area to see if we can hold the expansion and continuation of that momentum move. Other than that, right, we're going to be looking at the volume profile in relation with the composite profiles, and we'll be talking about order flow. Now, one of the other factors is that the setups that we're going to be talking about come from the volume profile. The general understanding and breakdown of where these setups occur is going to be based on the volume profile and how prices interact with distributions. So we're going to be looking at those based on the understanding of the expansion and pullback, as well as the fade from a low volume area into a mean reversion back into a heavy area of volume. So generally speaking, the types of volume profiles, like we said, there's session volume profiles, there's large composites like we have here, whether it's 100 days, 200 days, 300 days. Like I said, it doesn't really matter how large the heavy composite profile is, because when you look at it, the whole point of the heavy composite profile is to understand where there are really thick, heavy balances. Now, realistically, if I change it to 100 or 200 day, you're not going to see much of a difference. The areas are going to be the same. So we're going to be looking at these composite profiles a lot to dictate where balance is, as well as the key area extremes. And then we also have what we call maybe mini or micro composite profiles, which are hand-selected a couple of days, right? For instance, the last 5 trading days, we can group these last 3 or 4 to create a composite based on the most recent price action that we've seen. So hand-selected areas to study distributions inside of general larger composite profiles. So some of the common pitfalls that we have with volume profiles: chasing low volume nodes. Just because volume is low doesn't mean that it will reject. Doesn't mean that the whole area is going to be an area of interest. For instance, right, a lot of people, they just say, okay, bam, low volume node, right? This is going to be an area where we want to get long or whatever may happen. Context matters. It's the actual extreme that's created by the low volume node drop-offs, right? A lot of people, also I think a pitfall is they ignore a higher time frame profile. I always want to check with the composite profile. I always want to understand what's going on with the composite profiles rather than looking at session by session by session. Sessions, right, they're obviously going to give you a lot of information, but it's just a clearer image if I look at the composite profile. Another thing is forcing balance setups on trend days. So on strong trend days, when we look at these expansions that happen, everyone's trying to mean revert back into it and fade, 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 fade. When you have a strong trend day expansion, we'll talk about those as well, you generally just want to look at it from the perspective of where are the shallow dips when we start expanding outside of these profiles. So, like I said, the key volume profiles that we use and why. The composite profile, which is this huge heavy beast over here, the weekly or the last 5 days profile, and individual daily profiles. So here's how we're going to be using them. We're going to be identifying the daily bias, we're going to be identifying areas to trade from, which is the extremes, and we're going to be identifying directional changes, right? And then finally, we can identify the trade setups, which are pullbacks and breakouts. So if we cover this, right, semi-quickly, this is going to be split into 2 videos. The idea, right, step number 1 is the focus on composite profiles. What we're looking at over here with these composite profiles is the understanding of where balance is. So these balances, the beauty of it is that they don't change. Day in and day out, I'm abusing and using the same balances. So if I take a look at this general larger volume profile here, we have the understanding that we have this developing balance that's shaping up like this, and it's split into 2. So when I look at this, right, I'm going to be using this area like this, right, with a split over here. And I'm going to be using this area over here like this. So these are 2 general balances that we see. What I'm trying to do is I'm trying to group together the heavier volume regions, right, and identify where the biggest drop-offs of low volume to high volume are. These extremes over here, these very large drop-offs that are presented, you can see there are about 4 levels on the screen, right? If I drop off the first 2 numbers, we're looking at 620-ish, 520-ish, 430-ish, and 330-ish on the NASDAQ. So 23, blah, blah, blah. These are going to be the key extreme areas for the heavy-handed market participants to get active, meaning the only areas I want to trade are generally there. When I look at this and I identify how markets move in and around them, I'm looking at excess moves made from individual volume profiles, as well as the acceptance and the close of an individual session to generate that daily bias and understand where I'm trading from. For instance, when we get this large expansive move on Friday after Jerome Powell spoke, what we have in this situation is a move through 3 major volume areas, major distribution areas, which is acceptance to the upside. But I'm also looking at the most recent move, because if we try to move through the volume profile to the upside swing and fail, what happens is we create excess. This kind of excess over here, if we close back within, gives us a slight little bearish understanding that we could go and revisit lower band areas. For instance, the bottom of the major volume profile. On this day, on the overnight, we have a low volume excess move that closes within, meaning that we're going to be looking to buy into the bottom band of that distribution to see if we can move into and above this area so we can buy this area and continue on with our merry way. Now, I'm going to be using the weekly volume profile to add confluence to the whole ordeal. You can see the weekly volume profile's balance, right, is within this large major composite profile balance, which adds confluence to our idea. We can also use individual volume profile sessions to give us a little bit of a tweak in terms of where the areas are. For instance, if we have a low volume drop off on the overnight, this overnight over here, it might be getting a little messy on this screen, so why don't we erase some of this. So I'm going to be looking at low volume drop offs and where individual session balances may be. So if I'm looking at what's going on, I'm looking at this profile and I see there's a volume drop off over here, which is around 23,470 realistically. As long as we can push above and try to hold this, you can see we create a volume drop off at that area again. We have a minor area to continue the momentum of the trend, for instance. So if we're looking at this, as long as we continue into distributions higher and higher, we're going to accept into the bullish momentum. If that flips and we start accepting into distributions lower, that's going to change the general direction of the move. So there's a lot of information on volume profiles and auction market theory, the understanding of the premise. And what we're going to do is in the next video, we're going to be breaking this down a little more to understand exactly what we're doing with the areas and where we're trading them, along with the introduction of the trade setups and order flow. We're going to be talking about Delta next time as well to break things down and understand where these strong intermarket participants are confirming more of imbalanced movements based on order flow. So if you guys enjoyed this video or you're enjoying the course, drop a comment down below, hit that like button, and remember, we're doing a live recording of our 2025 futures course, a full breakdown of the system, step by step, a deeper dive than what you see here, and you guys can get a seat at the live recording. There's a link down below, and I'll see you guys there.